Hey, welcome back. Show's called Your Money, Your Wealth. That's Big Al. I'm Joe Anderson. We're talking strategies in regards to your overall home. Go to yourmoneyyourwealth.com. Click on that Retirement Readiness Guide. You can download it right there for free on your computer. Yourmoneyyourwealth.com. Click on that special offer. Hey, let's see how you did on the true-false question.
Refinancing and taking a home equity loan are the same thing. True or false? Well, that's clearly false, right? Refinancing, you've got a home mortgage already, and you refinance it. You get a new mortgage to pay off the old mortgage. Why do you do that? Maybe you get a lower interest rate, or maybe you want to take some cash out. That would be reasons to refinance. A home equity loan is a loan that sits on top of your current loan. You get a home equity loan, you still have that original loan. Now you got the home equity loan. Generally, to get additional cash out, that would be the reason why you'd want to do that. In general, home equity loans are variable interest rates. In terms of regular loans and refinance loans, they can be fixed or variable.
Yeah, now we're getting into some dicey territory, Big Al, because I think a lot of people, as they transition into retirement, want to be debt-free. I do not want a mortgage over my head. I do not want any payments. If things go bad, I know that I have my house and we can sell it and downsize as a last resort. However, for some of you, if you're thinking about it, just understand the terms to make sure that you get the risks and the return that you're looking at. So home equity line, as what Al says, is just fixed. Home equity line of credit, so that could be a revolving credit that could be there as a safety valve. So you want to make sure that you open this while you're still working before you retire, right? Because if I'm retired and I don't have any income, then I might not qualify for a home equity line. And back in the credit crisis, they also closed some of these credit lines as well.
They did. In fact, in 2007, 8, 9, that was my emergency cash fund, was a home equity loan. And then I realized it didn't work because it got shut down.
And then a cash out refinance. So some people do this, take the money out and then refinance the house, and then you have some liquidity. So all these options today are probably not all that great just because of where interest rates are. But if interest rates go down, which they will, they fluctuate, they go up and down. For some people, it might be just a full refinance. Let's say you have 15 years left and you're 65 years old. So that mortgage is going to be with you for the next 15 years. So some strategies, you might want to refinance just to get that payment as low as possible versus throwing a lot more liquid cash on that mortgage. Because what we see is that people take their liquid monies and they throw it at the mortgage and try to pay that thing off. They have a paid off home, but guess what? They have no liquidity. They have no other assets to create income.
Yeah, Joe, another thing I've seen is sometimes people will refinance as they retire, right before they retire, to get cash out, because maybe a couple years from then they start Social Security, or they get some sort of pension. Maybe the pension starts, or maybe the required minimum distribution starts and they've got a lot more money to pay this thing off. So it just depends.
Yep. Tax consequences. Well, a loan is not income, so it's tax free. So looking at different ways on how to bridge certain gaps, you're absolutely right. This could be ideal for some people and it could be a complete disaster for others. When you start playing with debt and leverage, it gets very risky. So you want to make sure that you've got time and cash flow, or you understand the risks if you're doing any type of cash out refinance, refinancing at a higher rate, all sorts of different things.
Now you can think about reverse mortgage. Now that's just the opposite. Instead of getting money to pay off your loan, or to pull cash out, I should say, and you're making interest payments and principal payments, reverse mortgage is just the opposite. Now you're getting cash back, or you're paying off a loan, or both, and now you're not making payments. You get to live in the house. It has to be your principal residence, and you have to stay living in the house, and you have to be at least 62 years old. So there's a few requirements to get there. But the concept is, if you want to stay in your home maybe for many years, decades, or even the rest of your life, it could be a good option. There's a few issues with it. You know, the interest rate's generally a little bit higher, the fees are a little bit higher, so just be aware of that. When you're thinking about that, look at all potential options.
When you look at a reverse mortgage, or it's called a HECM as well, it's a home equity conversion mortgage. there's some strategies is that if you open that up, you're going to receive kind of a line of credit inside the home. So you don't necessarily have to take money out. You don't have to pay it off. You don't have to take any cash, but you can create that line of credit within the overall home that you don't have to pay back because the equity is paying that thing back. Again, there's pros and cons. The fees could be potentially high, higher interest rates, right? People think they might get thrown out of their home. Sure, if you don't pay your property taxes, and there's all sorts of different rules and regulations here, it's just an option that people might want to consider as they continue to age through retirement, and if their safety valve or their cash or liquid assets start drawn down.
Right, and thinking about how much you can actually get, it's completely different rules than a regular mortgage. Because first of all, regardless of your home value, if it happens to be over about 1.1 million, you're limited to 1.1 million-ish in terms of home valuation. And then how much you get is dependent upon the interest rates and your age. Generally, Joe, you hardly ever see anyone get more than 50% loan to value from their value.
So basically how it works is that, all right, I own the home and then I'm going to pledge my house to the lender, the bank. And then the bank's going to pay me cash. I could get it in a form of a lump sum. I could get it as monthly payments. Or I could say, you know what, I don't want to pay any more monthly payments to my house. And then when I pass away, right, then that's when that debt is paid off, right? If there's still equity in the home, which there should be, right, well then the bank gets paid at that point. So the bank gets paid at the end, right, and you get paid from that equity up front. So it's just another way to think about a strategy to help you with cash flow potentially, give you some cash in hand.
And I think it's important to say the general rule, as long as you qualify and got the counseling, got the loan, is if you pass away and there's not equity, then the bank loses, right? And that's partly why the bank only gives you a certain amount up front, is they want to have plenty of cushion, right? So it's not like your heirs are going to have to pay off this debt. But what the downside is, with higher interest rates and fees, there may be less equity in the future for the heirs.
When we get back, we're going to talk about alternative situations, some unique things that you could potentially do as well, and then we're going to turn the show back to you to answer some of our viewer questions. If you need more help with this, you know where to go, yourmoneyyourwealth.com. Click on that special offer. It's our retirement readiness guide. Click on the special offer and you can download it for free. We got to take a break. We'll be right back.